If you had $500 right now and zero investing experience, what would you actually do with it? Not buy some stock and hope. I mean the real step-by-step version, the one nobody explains properly. Because here's the truth. Most people don't stay broke because they're bad with money. They stay broke because nobody ever showed them where to start. So in the next few minutes, I'm going to walk you through exactly how I'd build an investment account from absolute zero, which account to open, how to avoid the tax traps that quietly cost people thousands, and how to build a simple portfolio that can grow for decades without you having to babysit it every day. Quick note before we start. I'm not a licensed financial advisor, and nothing here is personalized advice, just a breakdown of how this stuff actually works, so you can make your own informed decision. Step 1. Picking the right account. Most people freeze at this step because there are dozens of apps promising to make you rich, and it's genuinely hard to tell which ones are legitimate. So here's the checklist I'd actually use. First, make sure the platform is a real regulated brokerage. In the US, that means it's a member of SIPC, which protects your investments up to $500,000 if the brokerage itself ever collapsed. In Canada, you're looking for CIPF protection, which works similarly. Second, look at the fees. A 1% fee sounds tiny, but over 30 years, it can quietly eat a huge chunk of your returns. Third, check the account types offered. And fourth, honestly, make sure the app doesn't feel like a maze every time you open it. Once you've picked a platform, you'll typically need 4 things ready: a government-issued photo ID, your social insurance number or social security number, proof of address like a utility bill, and a working camera for identity verification. None of this is unusual. Every legitimate financial platform is legally required to verify who you are. Step 2. The account type that actually matters. This is the part that separates people who build wealth quietly from people who lose a chunk of it to taxes without even realizing why. When you open a brokerage account, you'll usually see a few options. A standard taxable brokerage account lets you buy and sell whatever you want, but any profit you make is subject to capital gains tax, and depending on how long you held the investment, that can be a meaningful bite out of your gains. Then there's the retirement advantaged option. In the US, that's a Roth IRA. You contribute money you've already paid tax on, and in exchange, all future growth and withdrawals in retirement are completely tax-free. There are annual contribution limits, and they can change year to year, so it's worth checking the current IRS limit before you commit. In Canada, the closest equivalent for pure tax-free growth is the TFSA, Tax-Free Savings Account, where your contributions grow and can be withdrawn without owing a cent in tax, up to your available contribution room. Canadians also have the RRSP, which works a bit differently. Contributions reduce your taxable income now, but withdrawals in retirement are taxed as regular income. A lot of beginners assume these accounts cap how much you can ever have in them. That's not true. The contribution limit only restricts how much new money you can deposit each year. It doesn't cap how large the account can eventually grow. In theory, a TFSA, or Roth IRA, that started with modest yearly contributions could grow into a 7-figure account decades later, and you still wouldn't owe tax on the growth. That's the entire point of these accounts, and it's why I'd prioritize one before ever touching a plain taxable account. Step 3. Understanding what you're actually buying. Once your account is open and funded, you'll be staring at thousands of options. Individual stocks, ETFs, bonds, sector funds. It's overwhelming if you try to pick winners one by one. Instead, a strategy that's worked reliably for decades is the simple three-fund approach, popularized by everyday long-term investors who followed the philosophy of low-cost index investing. Here's how it works. Fund 1 is a broad domestic stock index, something that tracks hundreds of the largest companies in your home market, giving you a small slice of ownership in all of them at once. Fund 2 is an international stock index, covering companies outside your home country, so you're not overly dependent on one economy. Fund 3 is a bond fund, which tends to be more stable and helps smooth out the ride when stock markets get rocky. How you split the money between these three depends entirely on your age and risk tolerance. Someone closer to retirement might lean heavier into bonds for stability, maybe 40% bonds, with the rest split between domestic and international stocks. A younger investor with decades until retirement can typically afford to lean much more heavily into stocks, since there's more time to ride out any downturns. Historically, staying invested through market crashes rather than panic selling has been the difference between long-term investors who built wealth and short-term traders who didn't. Step 4. Making your first move. When you're ready to buy, you'll generally see a few order types. A market order buys immediately at whatever the current price is. Simple, fast, and fine for long-term investors who aren't trying to time small price movements. A limit order lets you set the maximum price you're willing to pay, so the trade only executes if the stock drops to that level. There are also stop and stop limit orders, which trigger a purchase once a stock hits a certain price, useful mainly for more active traders. For someone building a long-term portfolio, a standard market order is usually all you need. Small price differences of a few cents rarely matter over 20 or 30 years. Most modern brokerages also allow fractional investing, meaning you don't need hundreds of dollars to own a piece of an expensive stock. You could put in $25 and still own a small fraction of a major company. This alone has made investing dramatically more accessible than it was even 10 years ago. Step 5. Automate it and walk away. The single biggest mistake beginners make isn't picking the wrong stock. It's checking their account every single day. Markets go up and down constantly, and if you're refreshing your portfolio daily, you'll eventually panic sell during a dip that would have recovered on its own. The fix is boring but effective. Set up automatic recurring contributions, whether that's weekly or monthly, and let the strategy run in the background. This is often called dollar cost averaging. You're buying at all sorts of prices over time, which smooths out the highs and lows rather than trying to guess the perfect moment to invest. To put the math in perspective, someone contributing a modest amount every month for 20 years, assuming historical average market returns, could end up with a portfolio worth several times what they actually put in. Though, of course, past performance never guarantees future results, and your actual results will depend on the market conditions you experience. That's not a promise. It's just what disciplined, long-term investing has tended to produce over multi-decade periods historically. The part nobody talks about: knowing when not to sell. Here's something that trips up even experienced investors: the instinct to sell at exactly the wrong time. When prices drop, our brains scream that we need to cut our losses before it gets worse. When prices are climbing, we hesitate to buy more, worried we've already missed the good part. Both instincts are usually wrong for a long-term investor. The people who've built real wealth through the stock market over the decades weren't the ones who timed every move perfectly. They were the ones who kept contributing steadily and simply stayed invested through the noise. That's really the whole game. Pick a legitimate, regulated platform. Choose the tax-advantaged account first. Build a simple, diversified portfolio that matches your age and risk tolerance. Automate your contributions. And then do the hardest part of all: nothing. Let time and compounding do the heavy lifting. If this helped make investing feel a little less intimidating, do me a favor and hit that like button. It genuinely helps this video reach more people who need to see it. Subscribe if you want more breakdowns like this one, because there's a lot more to cover, from taxes to retirement planning to avoiding common beginner mistakes. And drop a comment letting me know where you're starting from and what you'd want explained next. I read every single one, and it helps me figure out what to cover in future videos. Thanks for watching, and I'll see you in the next one.